earthquake reported in Los Angeles area. Okay, yeah. It's
Seriously?
already hitting the news.
Wow. Okay. Well, I don't want to interrupt us because this is too good, but I didn't interrupt us. Mother Nature just did.
If we can take a second, though.
Yeah.
You did not expect an earthquake 30 seconds ago, right?
Great point.
Okay, you didn't.
No, ma'am. No.
Maybe you've thought about what you would do because you do live in California, but you weren't expecting an earthquake because when we first started talking, the ground was not shaking, right?
That's correct.
Then all of a sudden something happened. And the same goes with our health. You can be a professional athlete. You can do everything right as far as eating and vitamins and exercise and all that. But just like that, things happen.
Yeah.
And so the earthquake is actually, well, it's not a good thing if it's really bad out there, but nonetheless, the earthquake's a good example of things happening. I mean, you might be in Florida with a hurricane, okay? You get a heads up with a hurricane, but sometimes a hurricane spouts a tornado, and all of a sudden that is instant. Here in the Midwest, I'm in the Chicago area, we may get 30 seconds head notice before a tornado.
Right.
So things do happen with everything in life.
Yeah.
But with our health, we don't want to think about that change.
Right.
And sometimes,
right.
It happens when you least expect it.
Your relationship with money matters. I'm Michelle Perkins, and this is the Money and You podcast, where I will be breaking down your relationship with money, offering tough love money tips, and a money dating plan that will focus on lifting the barriers to success to help pave the way for better money practices and increased wealth. It's time to take control to live a limit-free life. It starts today.
Hello, hello, and welcome to the Money and You Show. My name is Michelle Perkins. I'm your host, and I have a really wonderful guest talking today about a topic that is near and dear to my heart. I know every time I do a show related to anything in this realm of aging, the cost of aging, I'm just thrilled to do it because, as many of you who listen know, I went through a long period of taking care of my parents, and I learned a lot of things. Most of them were complete surprises, not good surprises either. So I talk about it all the time because I don't want other people to be surprised. I want them to know what they're up against, whether it's your own aging or you're taking care of other people. So I am very fortunate today to have a true expert in the world of long-term care. And Matt McCann is with us, and I want to tell you a little about him. Matt McCann is a nationally known speaker on long-term healthcare issues and is sought after by the media for his expertise. He's recognized by the American Association for Long-Term Care Insurance as one of the top specialists in the country. Matt is among the selected few specialists in the nation endorsed by the AALTCI. So I'm super, super excited to welcome in Matt McCann. Hi.
Well, thank you, Michelle. I am really pleased to be on your show.
Well, I'm thrilled to have you, and you have quite a lengthy amount of experience being on shows. Maybe you can just tell the audience a little about your expertise in that realm, just for fun.
Well, I didn't grow up to be an expert on long-term care planning. I certainly had no clue that I would be doing that or doing anything involving insurance, because how boring is insurance, right?
Right.
I got to stop. I used to say most of my career was in the media. Well, now that I actually do the math, that is no longer the case. Which is another story whatsoever, but it proves that I'm also getting old, which I tried to opt out. I could not find out the opt-out button on aging, so it is what it is. But I had been primarily in radio since age 15. They had no clue that I was age 15. I had a lot of facial hair like most people did in 1975 that were in high school. And so I worked in radio, went to college, worked in radio while I was going through college, and had been in radio basically since, full-time in radio since 1998. And in 1998, my mom, at age 59, had a series of health events that eventually ended up in a nursing home and assisted living, home care, the whole bit. And with some transition in the media with the employer that I had at the time in Chicago, where I was working, I thought I would get involved in long-term care insurance because I saw a newspaper ad. Remember when you looked for jobs in the newspaper?
Yeah.
And I saw an ad about long-term care insurance, and I thought, I can do that temporarily. So I've been doing long-term care temporarily since 1998. So there you go.
Thank you. I love that. Well, and I love your other background because it makes it a lot of fun to talk to you. And now I'm remembering the facial hair in the 70s and my old high school boyfriend's mustache. And let's see, you brought back a lot of memories.
There you go.
Yeah. So, okay. I'm sorry to hear about your mother. That was very early time in her life to have an issue like that. So pretty serious and I'm sure traumatic for you. I think that's where a lot of us get our interest in this topic is from, seeing what happens with our parents. So.
And Michelle, that's part of the problem because the industry as a whole has been for decades catering to individuals with personal experience. And often by the time that personal experience happens, it's already too late for them because they have their own health issues, they're older, et cetera, et cetera. And the ideal time to plan for long-term care is part of retirement planning. Most of my clients are in their 40s and 50s. And while overall understanding of the problem is a lot bigger today than it was certainly in 1998, we still have a huge problem in that too many people are in denial of the consequences of aging.
Yeah.
There are still too many people that think health insurance or Medicare and their Medicare supplement, if they're age 65 and older, is going to pay for long-term care. The answer is no, it doesn't. It pays for short-term skilled care only. So the responsibility of long-term care in the United States is solely with you and your family. Unless you qualify for Medicaid or Medi-Cal in California, which is Medicaid for California. And you have to have limited resources, financial resources, to qualify for Medicaid.
Right.
So that's a problem. And aging is a reality. I have tried to avoid it. You probably have tried to avoid it.
Oh, I'm still trying. Yeah. We're about the same age. But
Well,
I'm still on a mission. Yeah.
He might be on a mission, but you know what? We are a day older today than we were from yesterday.
Yeah.
And tomorrow will be older than today. Which sounds like a political speech right now, which I don't want to get into. But the point is, the reality is, we have to deal with today. And a lot of times people tell me, I'm healthy. I don't need to worry about long-term care. That's exactly the time you need to worry about long-term care.
Yeah.
Because good health is the number one reason why people need long-term care. Let me repeat that.
Yeah.
Good health is the number one reason people need long-term care. And what I'm talking about, of course, is longevity. You don't have to be sick to need long-term care. Obviously, there are people with chronic illnesses and accidents and those types of things that create long-term care events. But longevity itself, just the frailty of aging, requires people need help with everyday living activities or even dementia, supervision due to a cognitive impairment. And you can't wait till those problems happen because at that point, the fire has already started.
Yeah, and I thank you for that because that is a good jumping off point for many other things. One thing you brought up was skilled nursing. So Medicare will pay for certain things, like you go into the hospital because you fall down and hurt yourself. Then they'll put you in skilled nursing for we just had an earthquake. A pretty rolly one, actually.
Really? Breaking news.
It's seriously, that's never happened to us, Tony.
Live on air?
Wow. Okay. Well, we'll wait for some aftershocks and see how it goes. That was a real one. That was like the whole room was moving. Wow. Okay.
Wow. Okay. Well, my iPhone is probably already going off. Earthquake reported in Los Angeles area. Okay, yeah. It's
Seriously?
already hitting the news.
Wow. Okay. Well, I don't want to interrupt us because this is too good, but I didn't interrupt us. Mother Nature just did.
If we can take a second, though.
Yeah.
You did not expect an earthquake 30 seconds ago, right?
Great point.
Okay, you didn't.
No, ma'am. No.
Maybe you've thought about what you would do because you do live in California, but you weren't expecting an earthquake because when we first started talking, the ground was not shaking, right?
That's correct.
Then all of a sudden something happened. And the same goes with our health. You can be a professional athlete. You can do everything right as far as eating and vitamins and exercise and all that. But just like that, things happen.
Yeah.
And so the earthquake is actually, it's not a good thing if it's really bad out there, but nonetheless, the earthquake's a good example of things happening. I mean, you might be in Florida with a hurricane, okay? You get a heads up with a hurricane, but sometimes a hurricane spouts a tornado, and all of a sudden that is instant. Here in the Midwest, I'm in the Chicago area, we may get 30 seconds head notice before a tornado.
Right.
So things do happen with everything in life.
Yeah.
But with our health, we don't want to think about that change.
Right.
And sometimes, it happens when you least expect it.
Well, and that's what happened to me. I mean, totally. My two parents, older for sure. I mean, based on their age, I guess I could have been expecting something, 94 and 87. Still driving, still living on their own perfectly well, didn't need a thing, took care of my disabled sister on their own. They were great. And, one day they weren't, basically. It was
right.
like within 2 weeks of each other, both down. And, and I'd like to use them as an example because I didn't know they had long-term care. My sister told me, and they couldn't tell me at the time. They were too out of it my dad had a mild stroke. My mom had fallen and was having surgery. And, nobody, I mean, they had one thing they were preoccupied with, paying the quarterly taxes. And they told me about that like 50 times, but they weren't thinking about, oh yeah, I have long-term care. It was some files in the file cabinet. They hadn't looked at it in forever. They just paid it on, auto pay. And didn't really remember much about it if I asked them. So my sister, fortunately, said, I think mom and dad have long-term care. So I went and dug around, looked for it, found a few bills, found a little bit of documentation, started calling, and lo and behold, I can't talk to them, the company. I wasn't a name on the list. And so that was the first hurdle of many.
Right.
So, yeah, and there are so many nuances to it. So I didn't have a good experience, as I told you when we talked previously. A lot of things that shocked me and made me think about the poor people out there who didn't have a me taking care of their long-term insurance, because I was the one on the phone waiting for hours to speak to somebody and then just talking to somebody for 30 minutes to be told I needed to make an appointment with somebody else and filling out paperwork applications, and then setting up the Zoom call so a third party could, interrogate my poor parent sitting in a wheelchair next to me about all their, capabilities and what they could do or not do. And they were sort of looking at me like, what are we doing? And so that was just to get it so that it could get started. There was a 90-day exclusion where, frankly, the majority of the costs showed up. We had full-time caregivers in the house for a while. That was a huge expense, but it was within the first 90 days, so not covered. So that was my kind of icky experience with it. And What I'm thrilled about having you here is that that was my impression of how it works, and you have obviously seen better scenarios than I did. So I'm excited actually to have you talk about what it could be.
Right. So, the claims process with any types of insurance, but I only deal with long-term care, is really the point of when the policy is the most important, is when you need it. Of course, you're going through a family crisis at the same time. Every insurance company is going to be a little bit different just because they are.
Yeah.
Today, most of the top companies use the same third-party resource to process claims. And I process claims all the time because of the number of clients I have across the country. The process is a lot easier, as are the policies, because with federal regulation standardizing a lot of these policies with regulated benefit triggers and other types of consumer protections, the process is a lot easier than it ever was with the old policies sold in the 90s and the 80s and before that. Plus, there are organizations that provide free claims processing. For instance, you could go to ltcnews.com. There should be an icon there about long-term care insurance claims, and they can help your family if you have a mom or dad or some other family member that has a long-term care insurance policy and you need help processing a claim. You can get those free resources there.
Interesting.
The point is, today's policies are a lot easier to work with because they're all written basically the same way because of federal standards. Most of them still have an elimination period, which is a deductible based on days, not dollars.
Okay.
Most people pick 90. You don't have to. If you want to spend more money for a 0-day deductible, like any other type of insurance, you can do that at a higher cost. But nonetheless, when people get a long-term care insurance policy, they're generally looking at, not spending the most money they could possibly spend.
Yeah.
But they want to take a catastrophic situation and make it manageable. Worrying about 90 days on a situation that may last 2, 3, 4, 5, 6 years is, for most people, not that big a deal. Now, depending on how someone's cash flow may be in the future, and they have the money to pay a higher premium, if they want to get a 0-day or a 20-day deductible, you can do that. The consumer is kind of in control. Now, the person selling you that policy, or who had sold you the policy in the past, may or may not have a lot of expertise or experience with the product. And I have run into individuals who had 180-day deductibles. I had one that had a 365-day deductible.
Whoa.
And, somehow they got a hold of me because of the internet. They were looking for advice. And it's like, well, why did you pick that deductible? Do you know why your mom and dad do that? They had no clue. They were insistent that their parents wouldn't have made such a stupid decision. My guess is that they made that decision because they wanted to keep the premium low, and they didn't really understand, probably the agent's fault, what that consequence would be. And the consequence, as you learned, Michelle, is not just money. The impact of long-term care is both on family and finances. And I think that's important for you to remember. Family and finances. Because if you're a person looking to get a long-term care policy and plan for the physical, emotional, and financial costs that long-term care will bring, when you need care, you won't be making those decisions most likely. It'll be an adult child most likely.
Right.
Okay.
Right.
And they're going to have to deal with all this emotional stuff, plus dealing with everyday life.
Right.
And then this long-term care policy, or lack thereof.
Mm-hmm,
okay.
Mm-hmm.
And so part of this equation in planning is that family portion, which is just as important as the financial portion. So, and that's why dealing with someone like myself, and there's other specialists other than me, believe it or not, but dealing with someone who really understands all these products, the underwriting standards, how policies actually get used at the time of claim, is absolutely critical. Then you can make a decision. Yeah, 90 days, that's not a problem. Or, you know what, the way my finances are, maybe we should spend a little more now and save a little bit of money down the road. That's fine. Then you can make those educated decisions.
Yeah, thank you so much for that. I didn't know, actually, that all of these things were potentially optional. I don't know if they really were or not, but they're decisions that you're making. So when you structure it, yeah, I agree. You know, you're younger, you're healthy, you think you're probably never even going to need this, but maybe you will. So you make different decisions than you would down the road, or if you've kind of had, you know, this experience with other people. So it is, I don't know even what you do with your mindset there. Do you try to, you can't really put yourself in the mind of a 70-year-old when you're 40, you know, it just doesn't really happen. But, yeah, I mean, you're weighing the risk, and that's hard to
do. The problem is denial. Yeah. Even if you've gotten yourself to the point, well, maybe we should plan on something and get a policy, you're still saying, you know what, this is going to be the biggest waste of money. It's not going to happen. I'm healthy. Look at me.
Yeah.
You know, but that guy across the street, he's the one. Of course, the guy across the street, you know what he's doing? He's looking back at you and saying, it's not going to happen to me, but that Michelle across the street, man.
Yeah.
And so we have to get away from that. And how do you get away from that? It's easy to say, use common sense. Okay, use personal experience. Mm-hmm. Look at how your parents have aged from the time that you were paying attention to it. Mm-hmm. Aunts or uncles, even grandparents. A lot of times I talk to people who say, well, I've never had anyone in my family ever need long-term care. So I start asking questions, and all of a sudden we find out that not only did they need long-term care, that the person I was talking to was providing it. They just didn't see it as care.
Right.
Most long-term care insurance claims start with what we call standby assistance. Okay. The trigger is with long-term care insurance that an individual policyholder must need help with at least 2 of the 6 primary activities of daily living or supervision due to a cognitive impairment. But since federal regulation includes standby assistance means you can still do things on your own. Yeah. But your doctor says you really need someone there to stand by just in case. So the fact that you went to your parents' house to make sure that they got in and out of the bathroom okay and got dressed for the day and set them up with their medications, et cetera, you may not have perceived that as care. You may know it took a lot of time and effort and you couldn't do X, Y, and Z because of it. But you didn't perceive it as care because you were thinking, oh, long-term care is nursing home.
Yeah.
Most long-term care, number one, is not nursing home. Most care is delivered at home, adult daycare, and assisted living. Raise your hand if you want to go to a nursing home. No one does. Right?
Yeah.
Who in the right mind wants to go to a nursing home? Nobody.
Yeah.
Unfortunately, there are people that have to go to nursing home because they didn't plan. They spent all their money and had to go to a Medicaid nursing home. Or they delayed getting quality care until their situation just progressed to a point where now it's a lot worse and they need that more skilled care on an ongoing basis. But when and I deal with this with clients, they have a policy and they don't want to use it. Mm-hmm. Mm-hmm. I remember not too long ago, I had a client, her husband had a stroke, and we were getting all the stuff needed to make the claim, and 2 of the daughters were on the phone. So I'm just asking general questions, and I asked, well, gee, when did the stroke happen? There was a pause, and the answer was 3 years ago.
Whoa.
And I go, 3 years ago? What have you been doing the last 3 years? So the daughters started explaining how they took turns taking time off work to be a caregiver to help mom take care of dad. And I go, well, why didn't you use your policy 3 years ago? Why didn't you call me then? Their answer was, we wanted to save the policy for a rainy day. And I'm thinking, it was pouring 3 years ago.
Yeah.
I didn't say that to them, but that's what I was thinking. Hopefully they don't watch your show. Nonetheless, they're now getting the benefits that they need. The daughters now have time to actually be daughters as opposed to caregivers. And the wife called me not that long ago and said, I now have a life.
Wow.
Because she was stuck at home.
Yeah.
It was like being in jail. She couldn't leave her husband alone. Now there's caregivers. She can have a life.
Wow, Matt, this is so interesting to me because our minds just, they decide on something. This is a lot of what we talk about on this show. And sometimes it really doesn't serve us. And yet we don't see outside of that particular, idea. I thought of it as something to help me with what I'm having to pay for. So money out and the long-term care comes in and kind of, compensates you for that. I would have never actually thought, well, because there was a period of time of me going over there every single day and helping them with this or that. And never occurred to me that was, caregiving in the sense that it would have been covered by the long-term care insurance because I wasn't, paying for something.
I usually deal with adult children at the time of claim. And generally, the first thing they tell me after we get everything in place is they tell me the fact that their mom or dad had a long-term care insurance policy gave them the gift of time. They don't mention money. They mention money second. First thing they mention is they actually had time to be family.
Yeah.
There's a physical, emotional, and financial burden that long-term care places on the entire family. And, not to say that money's not important, on a show that's, money and you, that's probably an important thing to, yeah, money's important. Okay. I'm not saying it's not. Makes the world go around, gives us access to things. But when we talk about long-term care, it's not the only thing. And I say family and finances in that order on purpose.
Yeah. And one of the things that I like to say is that there are three kinds of currency. There's money, there's time, and there's energy. And so all three of those are, you leave out the money, as you were saying, that your time and energy, goodness, it's an energy drain. I mean,
oh, God, yeah. And I have many extremely wealthy clients, people that if I could mention their name, you would say, them. You might know them personally being out there in LA land.
La La Land, yeah.
Because I've got actors, actresses, and CEOs and all that, professional athletes and all those types of people. Those people have choice. They could self-fund long-term care. Notice I didn't say self-insure. They can't self-insure it, but they could self-fund it.
Mm-hmm, mm-hmm.
But the reason they don't comes down to a lot of times family. They don't want to worry about it. Yeah, there's tax implications. I had one CEO, mega company. You would know this gentleman. Happens to live not too far from me. And I didn't know him, but nonetheless, I was delivering the policy in his mansion. And he wrote me the check. Back in the days, we actually wrote checks for things. Remember those?
Yeah.
And it was like $2,800. Okay. It was a great policy. This goes back to maybe 02, 01. Okay. And I never usually do this, but I slid the check back to him and I go, I'll call him Fred. His name isn't Fred, but I go, Fred, why are you doing this? He pushed the check back to me. And he said, he took his glasses off and said, son, I know I was in trouble when he said son. He goes, son, my long-term care is now your problem. I spend more money on a weekend of golf than I will on this policy. And now the problem you own, not me. And I thought, wow. He had choice to self-fund it. Someone would have still had to write the checks and decide on things. Now, he doesn't have to worry about that. But nonetheless, he now sees that problem is gone. Now, whether he was concerned about, the tax implications of selling off assets and all that stuff is analytical stuff like, people like you, Michelle, deal with. Some of that starts going over my head. But nonetheless, that stuff is obviously important too. But he didn't want this problem to interfere with his family or take up space in his head anymore. And it was done. It's over with. He no longer has to worry about that. He can worry about his golf game. And so that's a great thing.
Yeah.
But those types of people, they do have choice. The rest of us normal folks, we needed to safeguard income and assets, help preserve a legacy, give us access to quality care. But I still put in front of all those things is to reduce the stress, burden, and anxiety otherwise placed on the people you love. And I don't know if you can put a dollar and cent equation onto that, but that's worth a lot.
It is worth a lot. And I wish I'd had more separation myself. There was so much preoccupation with the financial aspects of things that it did absolutely take away from just the time, the better time that you could spend with people. So I totally agree with you. There are a lot of choices to make. And it becomes, it does become challenging because, of course, long-term care is going to pay something, depending on what your policy is. It may not, it's probably not going to pay for the full scope of the care that you need, I found. I mean, it was helpful, but it was a fraction of what the cost of ultimately the assisted living was for my parents. What do you suggest to people? How do you even look at this and figure out how much should I get? What makes sense as a premium?
Well, let's start with making sure that you're in control. Okay, you get to decide how much or how little your policy is. Okay. My general philosophy is to take a catastrophic situation and make it manageable.
Mm-hmm. Okay.
So when you need long-term care, you're going to have some kind of income coming in, be it Social Security, maybe you have a defined pension, earnings off investments. You're going to have some cash flow coming in. You don't want a long-term care event to impact lifestyle, your lifestyle as the person needing care, and perhaps a spouse's lifestyle who may have decades of life following your need for care down the road. So obviously I'd have to ask lots of questions, but between your long-term care insurance and part of your future or current Social Security check, that should take care of most of those expenses without creating a cash flow issue or a lifestyle change, or having to drain a lot of savings and go through the tax complications of that. Now, some people say, look, I want the insurance to pay more than that. Great. You want to write that check? We can do that.
Okay.
Some people say, I'm willing to co-insure a little bit more. I just don't want everything to just blow up.
Mm-hmm.
But I usually start by looking at where the cost of care for both home care and assisted living is where my client lives. Okay, so if you live in Los Angeles, for example, cost of care in Los Angeles is going to be a little bit higher than, let's say, somewhere in Huntsville, Alabama. Okay, we go to the cost of care calculator. I use the one on LTC News. It seems to be the most accurate out there. And while nursing homes cost the most, we also know it's the least used. Okay? And people tend to be in nursing homes for a much shorter period of time. Now, there's always exceptions to that, but we use this information to design an appropriate plan to make that catastrophic situation, make it manageable. So I look at home care, I look at adult daycare and assisted living. I find out, what do you expect to come in from Social Security when you retire? Do you have a defined pension? And then, if the cost of care is, let's say today, $5,500 a month, maybe you only need $4,000 a month with an inflation rider to escalate in the next 20 plus years down the road. Everyone's going to be a little bit different, but that's why we ask those questions. We have a conversation. There is or should not be a cookie cutter approach to long-term care planning. I mention that because most financial advisors and general insurance agents, they have their cookie cutter plan. Got to do this, this, and this. End of story. Mm-hmm. Well, that's absolutely wrong because cost of care varies so dramatically, and everyone is individually going to be different. There are people that have all their adult children living way far away. Their policy may look a lot more different than if all your kids live within 10 minutes. So we ask those questions and then match the individual's age and health, because every insurance company has their own underwriting criteria. We ask the financial questions so we can make proper recommendations. But ultimately, after I show recommendations, that client is going to then decide, I want a little bit more, maybe I want a little bit less. But we start from an educated starting point.
Thank you. I do love hearing this as well, because I found that trying to do this on your own is really tough, and trying to do it with a broker or somebody, like you say, who has one policy or one product that they offer, it can also be a mistake. So these are big. After I went through the long-term care experience, even myself going on Medicare, I hired a Medicare coach because I thought I am never going to understand all the nuances of this. And, in theory, it should be very simple, but I didn't even want to study up. I got an expert who also, was on the show, Emily, the Medicare coach. You can find that episode. I wish I could remember the number, but I can't. But she was great, too, at just looking, as you were saying, at your individual circumstance is going to be just its own thing. Just like when you go to a financial advisor, I mean, your goals and dreams are going to be different from the next person's, and so the pathway to that is different. So I think it's really important for people to speak to somebody who has the breadth of knowledge that you do. And I don't know that we said this, but you are actually licensed in all 50 states. And the District of Columbia.
And the District of Columbia.
Yeah. So I really want to mention that because you just by virtue of that alone, let alone your experience, you've got to be pretty well informed as to what the options are and what is out there for people. So I personally wouldn't make these decisions on my own. I mean, you can go wrong really easily.
No, and you're the same individual that helps you with your auto insurance and your homeowner's insurance. While they might have the ability to sell you or show you something, they probably have no clue. Even most financial advisors have no clue. And if they do offer products, they may only offer a product from one company. So you got to talk to someone that understands the products, the federal regulations that go with these products, the tax implications, the tax benefits, the partnership program, which most states participate in, which provides a policyholder with additional dollar-for-dollar asset protection. For a lot of people, that is absolutely critical. There are a variety of long-term care products. There's traditional long-term care insurance, which is what most people purchase, but there are also what we call hybrid products, which combine life insurance or annuities with a qualified rider from long-term care. They are regulated like the long-term care insurance. Unfortunately, a lot of insurance agents sell these products which don't meet federal regulations, and we need another 30 minutes to explain why, but a specialist like myself is going to know those differences, while an insurance agent or a financial advisor, that's not what their expertise is. And the underwriting criteria is the health information how an insurance company looks at your health and determining whether they're going to offer you coverage, and if so, at what rate. Okay? Whether it's a preferred rate, which would be the lowest cost, or a standard rate, or even a substandard rate. And that varies dramatically between company and company, as does the premiums. Mm-hmm. And insurance rates are regulated, so whether you talk to me or someone else, each individual company's premiums are going to be the same. The difference is policy design, the underwriting, and the pricing structure of that insurance company. And there's a lot of variables. So while for you, company A may be the best option, for your neighbor, it might be company B, and the person down the street, it's company C. And so it's not one company fits all.
Interesting. Okay. Let's talk for a minute. I don't want to run out of time before we get to this question about the premium increases. So people get the insurance. And what you just said made me also realize that it is much better to get it when you're young, I would imagine, and healthy. And
yep.
Because that's when underwriting is evaluating you, I assume. So you get it then, you got a pretty decent premium, but then every year you get some kind of a notice saying your premium is going up. Do you want to just elaborate on that?
Sure. So prior to rate stability rules that came in force, what we call the legacy products were sold decades ago, prior to the interest rate crash and prior to rate stability in force with most states. So no actuary ever thought that we would go through a extremely long period of time with extreme low interest rate rates. And I don't even know how many years it's been. You might know, but it's been a long, long time. Okay. Yeah. And the reason no actuary ever thought that interest rates would ever be this low for this long is because, quite frankly, it never had happened before. I think I talked to an actuary who said it back in the 1600s in jolly good England was the last time, and it was a fraction of the period of time that we are experiencing now and still, quite frankly, are in, even though the interest rate on my money market account is slightly bigger than it used to be. The reason interest rates are important is because federal law requires a lot of these insurance companies' reserves to be in products like federal bonds and other products where interest rates are a big factor. And if you're sitting there as an actuary figuring that you're going to earn X and you earn 1/4 of X, your only option is to go out of business or raise the premium. And that's what some of these companies did with these older legacy products. Now, not to defend an insurance company, but they had no clue that this would happen. Underwriting was less scientific in those days than it is today. So you have that factor. They're going through more claims that they thought they would at the same time. So we've got multiple problems. So they had to go to the Department of Insurance and ask for rate increases. Now, since that happened, everything is now priced based on the extreme low interest rate environment. So premiums today are actually priced appropriately. The products sold decades ago were underpriced, and some were even more underpriced than they should because the insurance company was trying to buy market share. Today, they can't do that. So when an insurance company tries to go to your state's Department of Insurance to get a product to be allowed to be sold in that state, their actuaries have to show the Department of Insurance that based on their underwriting criteria, based on their pricing model, that they expect that the premiums will remain level for the life of the product series. And I said expect, not guarantee. The only way now an insurance company on the products sold since these rules have been enforced can get a rate increase is they have to go back to that Department of Insurance, prove a substantial need based on actuarial reasons, not profit, and go across the board to an entire class. But there's more. Then they have to explain to the Department of Insurance why they messed up in the first place. Okay, so there's potential regulatory issues that insurance company may face if the Department of Insurance believes that they were negligent. So the Society of Actuaries, now I'm not sure you know this, Michelle, but the smartest people on the planet are actuaries. Just ask one, they'll tell you. The Society of Actuaries says the chance of rate increases on today's products is less than 10%. And with an expected rate increase of less than 10%. So only about 10% chance it's going to happen and the premium increase less than 10%. That doesn't mean there can't be things that happen that we can't predict. Okay, if they're bringing back these rocks from that asteroid or from Mars, they come back here, and all of a sudden there's a virus that gives every blonde person dementia.
Please no. Yeah.
Right, that's a joke. Sorry, it's probably not politically correct. Every dark-haired old white guy dementia. How's that? So they didn't expect that, but now they're getting much higher than expected claims. Things can happen, but now there are more consumer protections in place where worrying about higher premiums down the road is less of a concern than the product sold decades ago. Now, if you're the type of individual that wants guarantees, okay, you're an analytical, you want guarantees. You can get a hybrid product that has guaranteed premium. Okay, can never go up, and you get a death benefit. Okay, there is one traditional long-term care insurance company that allows a single pay. You just pay one premium. Well, if you're not paying a premium, they can't raise it, right? You've already paid the premium. So there are ways based on your personality to give you more peace of mind if that is a concern. But the reality is, well, I would never say there's zero chance of a rate increase with traditional long-term care insurance, because that would certainly be inappropriate. It's less of a problem because there are more safeguards in place. But if you want more peace of mind, we've got product options that can take care of you for those.
Okay. Very, very interesting. So, yeah, and my parents' policy was decades old. They had never opted to, or maybe they did for a minute, and then they stopped paying the increased premium. So their coverage wasn't so great. And I don't think they knew that was going to happen.
Yeah, that's a good point we should spend just a minute or so on. If you have one of these older legacy products, or you have a parent that does, and they get a rate increase, there are options to reduce your benefits to mitigate the cost of the higher premium. Now, the ones that the insurance companies offer you as options may not be the ones that are best for you. It might be best for them. So a lot of times, again, because of the internet, I get these people that are not clients of me, but they don't know who their agent is because they're long gone. Mm-hmm. And they ask, well, is there anything we do? And I'll help them. I'm not going to spend all day, but there are ways to lower your benefits safely. And some companies make it easier than others. Okay, there's some companies that make it difficult. Most companies, there are a variety of ways where you can lower your benefits and safely reduce the premium without hurting you as the policyholder. So if you can't find the agent, find someone that can say, hey, what things should I be looking for to be able to lower my premium, but I don't want to give up the policy, nor do I want to make the policy worthless when I need it.
Yeah. Well, we're completely out of time, but I can't resist sharing this one little tip that in my frustration, one of the women that I was on the phone with talking to the long-term care company shared with me. Probably shouldn't have, but I loved it. It was the highlight of my long-term care experience where I was talking to her and she said, I told her that we hadn't ever paid the increased premium. The coverage wasn't that great. And she said, when you're accessing the insurance, you don't pay premiums anymore. So make sure you're not paying any premiums. and you're in the flow here. You're doing the insurance. Then you're going to get a letter, and it's going to offer you an upgrade. Take the upgrade then, because you're not actually paying premiums because you're using the insurance, and then it'll bump up the coverage. So that was I never got a chance to actually do that, but I thought that was the sneakiest, coolest tip that I heard along the way. So
that's right. So luckily that was shared to you, and that's why having someone, whether it's someone at the insurance company, and there are some good people that work for insurance companies, or an agent or someone else that is aware, that can help you not just design a plan for you, but to help with a loved one who is trying to access the benefits from their policy.
Yeah. Well, Matt, thank you so much. I love talking to you about this, and it's kind of, I'm like you 30 years ago, the idea that I would be having so much fun having a conversation about long-term care insurance, I'm not sure I would have been able to visualize that. But thank you. You're a wealth of knowledge. It's a super important topic. There are choices out there, as you've described. And there are also people like you who really know how to manage this process, so you don't have to. So please let people know how to contact you and get in touch with you, however.
Yeah, the best way, so you don't have to try to spell McCann, is if you go to the internet and type in radioltc.com. So it's www.radioltc.com. That will forward you directly to my website. All my contact information is there. The federal government has a fairly good longtermcare.gov is their website for information on long-term care. And the other resource that I recommend is LTC News, which is www.ltcnews.com. That has a lot of resources as well. But radioltc.com is me, and I am licensed in every state and the District of Columbia.
Okay. And as anyone listening can tell, you know your stuff. You're also a very friendly, nice guy, and you seem like you really care. So I think people would do themselves a great service to connect with you. And
thank you, Michelle.
I just want to thank you for being on the show. I totally enjoyed it and learned a lot myself. So thank you.
Thank you for inviting me, and it's been a pleasure. It's been fun.
I appreciate your time very much. And thank you, listeners, for tuning in. I hope you got a lot out of this show. I hope you'll connect with Matt if you have questions on this topic or need long-term care insurance for yourself or someone else. And love having you listen to the Money and You Show. You can find us on all the podcast platforms and Roku and the Limit Free Life YouTube channel. And we love doing the show and bringing you great information like we did today. If you have questions or you have topics you'd like to hear about, you can always reach out to team@limitfreelife.com. And with that, we'll see you next week.